Hey, what's up everyone? Bill Lethman here for Money Evolution. In today's video, I'm going to be talking about 5 Wall Street myths that could actually ruin your retirement. But real quick, before I get into today's video, don't forget to hit that like or subscribe button. We're uploading videos here usually about 3 to 4 times a week, and we cover a variety of topics about personal finance, helping you plan for retirement, Social Security, a whole bunch more. So hit that subscribe button and let's jump right into today's video. Okay, so myth number 1 is that the stock market always goes up. And I think this is a big one. So when we look back historically at some of the major US stock market indexes, we learned that over time, these indexes have averaged right around a 10% annual return. But when we look a little bit deeper, let's say at the Dow Jones Industrial Average going all the way back to 1896, we find that there are these secular bull and bear markets. Now, some of these bull and bear markets can last for quite a while. So, for example, since 1896, there have been 5 of these secular bull markets that have lasted on average for about 10 years. And since 1896, we've seen 4 of these secular bear markets that have lasted on average for about 17 years. So, in fact, we've actually seen these bear markets last considerably longer than the bull markets. And the most recent of these bear markets was, of course, in 2000 when the internet bubble collapsed. And we saw from 2000 to 2002 nearly a 50% drop in the major market averages, and then we got a little bit of a brief recovery, and then we of course had the financial crisis that happened in 2008 where we saw another 50% drop in these major market averages. So that sideways market, that bear market, lasted for about 11 years, starting in 2000, ending in 2010, where we saw the total return of the Dow Jones Industrial Average over that time at 0.7%. Not 0.7% per year, but 0.7% cumulative return over that 11-year time period. So I think that's very important to understand that we're likely going to continue to go through these bull and bear markets over the course of our lifetime. Now, when we're working and contributing to our 401k plans or IRA accounts, saving money for retirement, the number one thing that mattered was the average of the returns, because all of that market volatility didn't really make that much of a difference because you were hopefully dollar cost averaging into those funds and maybe buying more shares when prices were lower and buying fewer shares when prices were higher, and that tended to kind of smooth that out. But in retirement, as we're going to talk about with some of these other myths, as you start to withdraw funds from retirement, those sideways or down markets can have some very significant negative impacts on your ability to sustain that money over the rest of your lifetime. Myth number 2 is that diversification works. And I think this is another area where many of us have been led to believe that if we simply just spread our eggs out into a whole bunch of different baskets, that it'll somehow magically reduce or almost eliminate some of the risk or volatility that we have in our portfolio. And I have 2 major issues with this diversification theory. Number 1 is that it still can expose us to considerable downside. Take 2008 as an example where almost nothing worked in 2008. But if we take our hypothetical retirement asset allocation, 60% stocks and 40% bonds, and we'll assume that your 60% in stocks was in the S&P 500 and the 40% in bonds was in the Barclays Aggregate Bond Index. If you had that split in 2008, you still lost about 23% of your value during that financial crisis. So that's still, for a retiree, a pretty significant downturn. The second issue that I have with the diversification theory is that by owning a little bit of everything, you're always going to have some asset classes or categories that are just simply not performing very well. A perfect example of this is alternatives, and a lot of portfolios will advocate for having, let's say, some gold in the portfolio. And if you go all the way back to the early 1980s, 1980, gold hit $800 an ounce, and then that was its peak for about the next 28 years, and basically traded down from that $800 level until finally in 2008 gold reached that $800 milestone again. So there was a 28-year period that if you had asset allocated and thought that having a piece of gold in your portfolio made sense, you would have been down that entire period of time. Here recently, international investments have significantly underperformed US investments. So the MSCI World Index over the last 5 years has only averaged about 1.7% over the last 5 years. And so again, if you had allocated to that international sleeve, that would have been significantly underperforming versus those US investments. So the issue really then becomes is how are you going to trade and balance this portfolio, because how many people would have the wherewithal to hold on to one of those asset classes through those significant periods of time where the asset class might be down. So we advocate for a little bit different strategy with the portfolios that we manage, where we use a system of relative strength ranking to build our asset allocation models. And it starts at the top level where we decide how much money goes into stocks versus bonds versus maybe international, or if we're going to have a sleeve in some type of a commodity. And then we even balance that down into the next category too, which is if we like stocks, what kinds of stocks do we want to own? Because just like we saw with these major asset classes, there may be times when technology, for example, is doing significantly better than something like healthcare or industrials. And so we want to kind of direct our portfolios towards those areas that are showing the strongest performance. So diversification, this idea of just having a little bit of everything, may not work quite as well in the real world as it does in theory. So hopefully that makes sense. Okay, so myth number 3 is on the 4% rule. And the 4% rule is something we've talked about here on the YouTube channel and over on our blog. And I actually like the 4% rule as just a rule of thumb. However, I think there's a few issues with it that I'm going to talk about here, and some things I think we need to be careful of as we're starting to do some of our retirement income planning. So for those of you that aren't familiar with the 4% rule, it was created by a person by the name of William Bengen, who was a financial planner back in 1990. And he basically said that if you limit your withdrawals to just 4% of your total portfolio assets over retirement, that you should have an above average chance that that money is going to last you for a 30-year retirement. And that assumed a couple of things. It assumed that you were going to increase that 4% by 3% every year to keep up with inflation. So whatever that number was, you're going to index it a little bit for inflation every year. And it also assumed that you were going to have a 60-40 retirement mix, 60% stocks and 40% bonds. That's something we talk about a lot here. Okay, so what are my issues with the 4% rule? Well, number one is that there's been a lot of new research and a lot of new studies that have been done since 1990 on the 4% rule, and actually suggesting that 4% might actually be a little bit too high for our retirement income withdrawals, mostly because of some of the recent downturns in the financial markets and also because of the low interest rate environment that we're in right now. But one of these research pieces was done by Dr. Wade Pfau, who is a professor of retirement income for the American College of Financial Services. And he actually came up with and said that it's not 4% anymore, it's 3%. So that's a big significant difference. So a couple of other issues that I have that I just talked about is number one is the low interest rate environment. So back in 1990, when William Bengen did the original research, the 10-year Treasury was over 6.5%. Today, as I'm filming this in April of 2019, the 10-year Treasury is sitting at just over 2.5%. So again, thinking about that 60-40 retirement split, if 40% of your assets are in bonds or fixed income and the 10-year Treasury is only paying 2.5%, and that original research was done when it was at 6.5%, well, that's a big gap to kind of make up there. The other issue that we have is just looking at where the stock market is. So we talked a little bit about that in some of the other myths that we just talked about here in this video, but also too, what are the forecasts for the financial markets? So of course, nobody has a crystal ball on this, but I was reading an article here recently where it was polling some top names in finance, what they thought the projections were on the stock market over the next 10 years or so. And Warren Buffett actually came back with his answer, and he says that he thought the stock market was going to average a negative 2% over that 10-year time period. Another big name in finance, Robert Shiller, who was actually a Nobel Prize winner in economics in 2013, actually predicted it was going to go up by 2.6% over the next 10 years. So neither one of those are very good for maintaining that 4%, especially when we consider, again, what we just talked about, the low interest rate environment. So the final thing that I want to talk about here as it pertains to the 4% rule is, remember, all of this research that's been done has been studying the probability of having your money last for retirement of 30 years. So in reality, I hope many of us will actually spend more than 30 years in retirement. Obviously, the longevity rates are going up. Many people are retiring earlier, and so a retirement of 35 or potentially even 40 years or longer could be a very real thing. So we're starting looking at the probability of having our money last for 30 years. It just simply might not be long enough. Myth number 4 is just buy the index. And I think this is a big one that a lot of people have bought into here recently. And we can see that just simply by the amount of money that's been flowing into index funds over the past couple of decades. So just as an example here, back in 2002, index funds represented about 4.5% of the total money in the US stock market. Today, that number is now over 20%. And according to Moody's, in the next 2 to 3 years, we could see index funds over 50% of the total assets in the US stock market. So one prominent figure in the world of indexing is Jack Bogle, who is the founder of Vanguard Funds and actually kind of the creator of the index fund. He recently passed away here last year, but in a recent interview, he says, "I don't believe that such concentration would serve the national interest," speaking about having that much money in index funds. And I think he said that in one of his most recent interviews that he did before he passed away. There's a couple of issues that I have with index funds and some things that we should learn before we decide to buy index funds for our portfolio. So number one is, which index do we buy? So believe it or not, there's now more than 70 times as many indexes out there as there are publicly traded companies in the entire world. So when I read that here recently, I almost couldn't even believe that, but it came from the Financial Times and it was a survey done by the Index Industry Association. So 70 times more indexes than publicly traded companies. The second issue that I have with index funds is how many of these indexes are actually created. So many of these indexes, like the Standard & Poor's 500, are actually what are called market capitalization weighted indexes. And what that means is that the biggest stocks within that index are where most of the assets go. So just a quick example of this. So the Standard & Poor's 500, if you take the top 3 market capitalization stocks, those account for 10% of all the assets in the Standard & Poor's 500. If we take the top 10 stocks, which obviously include those 3, now we're up to 20% of all the assets in the index. And if we take just 50 stocks, it accounts for about half of the money in the Standard & Poor's 500. So it's a very heavily concentrated portfolio in those big names. And that brings me to my third point about indexes is, does that make sense? Is the approach that many of these indexes use, and that's simply to invest the money simply based on size of company, is that the best, what we call factor, is that the best factor to use when building out a portfolio? So one of the reasons that an index like the Standard & Poor's 500 kind of works is because it applies that factor with extreme discipline. So the Standard & Poor's people, they don't care who the President of the United States is. They don't care what the Federal Reserve is going to do, if interest rates are going up or going down, or if we're at war or at peace. All it does is just simply buy big stocks. So again, the question that we like to ask is that the best factor to use? And when we look historically, and we read books like What Works on Wall Street, Jim O'Shaughnessy did some great work on this. I've referenced that in some of our other videos. But he talks about other factors such as price to earnings ratio, and just simply looking for companies that have the lowest price to earnings can significantly add value to a portfolio over long periods of time. In fact, it actually beats those indexes in some of his research work from that book, What Works on Wall Street. Other factors like return on assets or companies that have low debt, those are things that we think make a whole lot more sense in building a portfolio, so look for those positive attributes. One of the issues that basically the index people propose is that it's the active versus passive debate. And so we have these active managers that are constantly buying and selling things. And the problem with that is the human element. And humans oftentimes let emotions get in the way. And even though we might know some of the right factors to use, a lot of these active portfolio managers will maybe deviate from those things from time to time. And that is one of the reasons that indexes tend to do better than those active managers. What we believe, though, is there's a kind of a happy medium there in between active and passive, where we can take the passive approach and utilize that same discipline, but utilize potentially better factors like price to earnings ratio or momentum factors or return on assets, low debt, and we find that those things can add some significant value to portfolios over a long period of time. So one of the things I talk about all the time is indexing works until it doesn't work, and we've seen this in countless examples here. If we look back to the late 90s, what did the Standard & Poor's 500 have most of its money invested in? tech stocks right before the tech bubble burst, essentially. Going back to 2007, early 2008, what did the Standard & Poor's 500 have most of its money invested in? It was financial companies right before the financial meltdown. So these indexes tend to gravitate towards those areas that are doing the best, but they have no mechanism to change course or direction once that asset class maybe falls out of favor, like it did with the tech bubble or the financial bubble bursting in 2000 and 2008. So myth number 5 is annuities are bad. And this is something we've talked about in some other videos. We talked about Ken Fisher, who's been on CNBC. He's in magazines. He's talking about how much he hates annuities. And it seems like this is kind of a general theme that's been out there and it's been promoted by a number of people in the financial community. And quite honestly, I think that annuities get a bad rap. And if you'd like to check out some of those other videos where I get into a whole lot more in depth about them and talking about some of the reasons that we tend to like annuities for a lot of people as they go into retirement, we'll put some links down below the video here where you can access some of those. Now, let me say this, annuities are certainly not right for everybody, and there certainly is a lot of due diligence that you should do before you buy an annuity. But I want to start off and talk about annuities and give you a little bit of a story. So imagine that you're retired, and here in Michigan we've got a lot of people that have retired from the automotive industry, and although they've made some changes here recently, a lot of those people, a lot of our clients have pensions. And a few years ago, some of the big companies like GM and Ford and Chrysler, they have started buying out people from their pensions. So let's imagine for a minute that you're maybe sitting out on your back patio and it's noon on a Tuesday, so you're retired and you're just loving life, but you get a knock at the door, and somebody comes up and says, hey, I'm so-and-so, I'm from the pension department. And now in reality, they don't actually do this, they send you a letter, but we're gonna fantasize here for a moment. And they said, hey, I'm from the General Motors pension plan, and I know you're getting a check every month for $3,000, but in exchange for that, we're gonna give you a check for $500,000. And you can do with that money whatever you want, but you're no longer going to get that $3,000 check anymore. And this is a very real scenario. The numbers, of course, might be different there with it, but this is a very real scenario that many people were faced here over the past couple of years or so, where some of these companies have bought out people's pensions. Now, before all of this, you were sitting on your back patio, and maybe you had some money from your 401k or your IRA invested in the markets and everything like this, but you maybe had a lot of your basic retirement needs covered, maybe by Social Security and maybe supplemented by that pension. So if you take that $500,000 check as an example, what are you going to do with that? Well, we talked about a number of things. We talked about the 4% rule, the 60-40 retirement portfolio, but you're going to have to invest that money into something that hopefully is going to produce some return. So before all of this, maybe you had very little concern or care about what the stock market's doing. The stock market could be down 200 points or up 300 points, but you had most of your retirement income covered by those predictable sources of retirement income. But as soon as you put that money into the market, now what are you going to do? You're going to be waking up and you're going to be opening up the paper, going online, looking at what's the financial market doing? Do I have too much money in stocks? Should I put more money into bonds? And maybe that's going to create a little bit more of an anxiety issue for you. So annuities can be that predictable source of retirement income. So just like we talked about, a pension is actually a form of an annuity. So as you're starting to put together some of your plans for retirement, don't completely discount the idea of an annuity just because there's some people out there talking negatively about annuities. So again, we talked about the 4% rule and limiting your withdrawals to 4%. We talked about why maybe 4% is even a little bit too high. Maybe the new number is actually 3%. We talked about these low interest rates that we see in bonds, the 2.5% for the 10-year Treasury. So just looking at some numbers, again, this is in 2019, but a 60-year-old today might be able to generate 5% or more of guaranteed retirement income for the rest of their life, whether they live to be 90 or 95 or 105. And that's something that you really can't do with any other type of an investment as you're going into retirement. If you're married, annuities can produce that income not only for your lifetime, but also for you and your spouse. So again, it's another way to protect those retirement dollars. And can that potentially eliminate some of that stress of the ups and downs of the financial market, so you can be back on your back patio and having a drink and relaxing and not so much tied to worrying about what the stock market is going to be doing on a day-to-day basis. So there you have it. So those are 5 Wall Street myths that could ruin your retirement. If you like what we're doing here, don't forget to hit that like or subscribe button. Check out some of the links below in the video. Again, we're putting out videos usually about 3 days a week, and we cover a variety of topics, mostly about retirement planning. We talk about Social Security. We also cover a number of personal finance topics as well. So be sure, subscribe to the channel, and I look forward to seeing you back in one of my next videos. Thanks.